stop for a moment. This is not a rally. It is not messaging, and it is not a news cycle. This is collections, not politics, not symbolism, not theater. It's the same process that plays out quietly in thousands of cases every year. A debt file that begins as paper and ends with control over an asset. When people try to turn a seizure into a political story, they usually skip the only thing that actually matters, the record. So before assuming this is a sudden attack or a dramatic escalation, focus on the document that does not care about anyone's opinions, the enforcement order, the writ, the levy authority, the piece of paper that explains why an aircraft that normally doesn't sit still is sitting still today. That document is why the wheels aren't moving. And here is the key point you need to understand. If the IRS is targeting a private aircraft, especially a large, high-profile one, this is not the beginning of enforcement. This is the end of a long process that offered multiple off-ramps along the way. You do not wake up one morning to find the IRS seizing a jet because they wanted to make a statement. The agency has to earn that moment through procedure, notices, deadlines, waiting periods, internal approvals, and documented failures to resolve the debt. All of that takes time. What happened in the scenario we're discussing is that the IRS filed a formal enforcement action targeting a Boeing 757 private aircraft. The filing identifies the plane by registration and location. That level of specificity is not optional. Aircraft are uniquely traceable assets. Tail numbers are public. Registration records are searchable. Ownership structures can be layered. Liens can be filed. Financing can exist. Any mistaken identification becomes a legal vulnerability. That's why aircraft seizures only happen when the paperwork is tight. So let's walk through how this actually happens. Not the commentary, not the speeches, the boring part, the timeline. Because tax enforcement is almost never one dramatic act. It is a sequence, and that sequence leaves footprints. Step 1. Assessment. Everything begins with an assessment, not a rumor, not a press report, not a guess. An assessment is the government converting a calculation into a legally collectible debt. It can come from audits, underreported income, disallowed deductions, unfiled returns, or IRS substitute filings. However it starts, the government has to land on a number. That number becomes the backbone of the entire case file. Step 2. Notice and demand. After assessment, the IRS sends notice and demand for payment. These are the CP notices people often reference. They matter because they document that the taxpayer was informed. The IRS does not assume you know. It proves that you were told. Step 3. Escalating notices. If payment or resolution doesn't happen, the notices escalate. Billing becomes warning. Warning becomes urgency. These communications are often sent by certified or tracked mail. Why? Because later, the taxpayer may argue they were never properly notified. The IRS anticipates that and builds a defensible record. Step 4. Federal tax line. If notices still don't produce results, the IRS files a federal tax lien. This is where confusion often starts. A lien is not a seizure. A lien is a public claim against property and rights to property. It affects credit. It scares lenders. It complicates sales. It tells every other creditor that the government is now in line, often at the front. The lien is the stake in the ground. Step 5. Final notice of intent to levy. This is the critical step most people ignore. Before the IRS can take property, it must issue a final notice of intent to levy and provide the right to a collection due process hearing. This is where the taxpayer can argue procedure, hardship, alternatives like installment agreements or settlements. The IRS must consider those alternatives, and courts later review whether they did. This is where the off-ramps exist, but off-ramps only work if they are taken. Step 6. Levy and seizure. Only after those steps fail, because of non-response, non-cooperation, default, or inability to pay, does the IRS move to physical assets. And that brings us to why an aircraft is such a big deal, why aircraft seizures are rare. Physical seizures are uncommon. Bank levies are easier. Brokerage accounts are easier. Wage garnishments are easier. Vendor payments can be intercepted. Aircraft are the opposite. They require storage, hangar space, security, maintenance, insurance. Letting an aircraft sit improperly destroys value, and destroying value defeats the purpose of seizure. Selling aircraft is also complex. It requires specialized appraisals, qualified buyers, and a process that can withstand scrutiny. And because aircraft tracking is public, the agency knows the action will be visible. There is no stealth mode with a jet. So when the IRS proceeds anyway, it usually means they believe the file is airtight. That's why aircraft seizure is almost never a first move. It is a last move. Why now? If you're asking why this happens at a specific moment, the answer is usually practical, not political. Either patients stopped producing payment, cooperation broke down, new information emerged, or the IRS determined collection was at risk, meaning the asset could be moved, transferred, or further encumbered. When collection is deemed at risk, timelines compress. The money math. People hear Boeing 757 and imagine huge value, but the number that matters is not retail value, it's liquidation value. Forced sales are discounted. Buyers know the seller is compelled. Risk is priced in. A plane estimated at $20 million might realistically recover $12 to $14 million before costs. Then subtract appraisal, storage, maintenance, security, legal, and auction fees. The IRS does not take this path unless the debt is large enough to justify the effort. Priority matters aircraft often have secured lenders. Those lenders may be paid first depending on priority. The IRS only recovers what remains. So when the IRS seizes an aircraft, it usually implies one of two things. There is substantial equity after secured claims, or the seizure is being used as pressure to force settlement. Both are standard enforcement logic. How tax debt grows. Tax debt rarely starts large. It grows through interest, penalties, compounding, and prolonged dispute. A $5 million deficiency can become far larger over time. Once balances cross into 8 figures, enforcement posture changes, not because the law changes, but because tolerance for delay decreases. What happens after seizure is not the end, it's the beginning of liquidation. The IRS must appraise the asset using qualified professionals. The sale must be defensible. The taxpayer still has rights to challenge procedure and propose resolution. Sales must be public. Proceeds are distributed by priority. Excess funds, if any, return to the taxpayer. This is not confiscation. It is collection. Why this matters. High-profile cases matter because they make procedure visible. If the IRS follows its rules, it reinforces that the system applies equally. If it cuts corners, courts intervene, and that affects everyone. Precedent matters in collections, too. What to watch next? If you're tracking a case like this, watch the paperwork, appraisals hearing requests, notices of sale, priority disputes, releases tied to payment. Ignore the noise. Because the story of IRS enforcement is written in notices, liens, levy authority, and filings, not press conferences. This is what collections looks like when it reaches its endpoint, not a surprise, not a performance, a file that ran out of off-ramps. No one is above the law. No one is denied due process. Both can be true at the same time. And when procedure is followed, the outcome is predictable. The asset becomes money. The money pays the debt, and the system moves on. That's not a threat. It's not a promise. It's how tax enforcement works when it's functioning properly.